When a tech startup goes bankrupt, the founders lose everything, and the employees lose their jobs. But the venture capitalists who funded them, they still get paid millions. Silicon Valley presents venture capital as a partnership between visionary investors and brave founders. But the reality is much darker. It is a highly engineered financial machine designed around a concept called the power law, where 90% of companies are expected to burn to the ground just so one can become a unicorn. Today, we are exposing the economics behind venture capital, the secret 2 and 20 fee structure, and why the system is built so that the house almost always wins, no matter what happens to the company whose name is on the door. Here's the first thing almost nobody outside the industry actually understands. Venture capitalists are not using their own money, they're using someone else's. VCs raise massive pools of capital from what are called limited partners, or LPs, university endowments, pension funds, insurance companies, wealthy family offices, and sovereign wealth funds looking for outsized returns they can't get from the stock market. The VC firm itself acts as the general partner, managing that pooled money and making the actual investment decisions, but the capital being deployed belongs almost entirely to those outside institutions. This single fact reframes the entire industry. The founder pitching in a conference room isn't the VC's customer. The LP writing the check for the fund is the actual customer. The founder, and by extension their entire company, is the product being packaged, managed, and eventually sold to satisfy that LP's demand for a return. Every decision a VC makes, which startups to fund, how hard to push them to grow, when to force an exit, gets filtered through one question first. Does this serve the fund's obligation to its actual paying customers back at the endowment or pension fund? The founder's dream is real, but inside the fund's spreadsheet, it's inventory. This is also why VCs raise new funds every few years rather than reinvesting profits from one fund into the next, since each fund is a legally distinct product sold to LPs with its own fundraising pitch, its own performance track record, and its own 10-year clock ticking from day one. A general partner's entire career, reputation, and future earning potential rests on being able to walk back into that same room of endowment managers every few years and raise an even larger fund, which means the pressure to show strong returns on paper is constant, long before any startup in the portfolio has actually proven itself in the real world. Now here's where it gets genuinely uncomfortable, because this is the part of the model that guarantees VC partners get rich whether or not any of their portfolio companies actually succeed. Most venture funds operate on what's called a 2 and 20 fee structure. The 2 refers to a management fee, typically 2% of the total fund size, charged every single year regardless of performance. Raise a $100 million fund, and that's $2 million a year, flowing directly to the VC firm just to keep the lights on, pay salaries, and cover office space, guaranteed for the entire life of the fund, which usually runs 8 to 10 years. Do the math across a full fund lifecycle, and that's roughly $20 million collected in pure management fees before a single successful exit ever happens. The 20 refers to carried interest, commonly called carry, the VC firm's cut of the actual profits once the fund eventually returns money to its LPs, typically 20% of everything above the original invested capital. This structure means a VC partner draws a substantial, comfortable salary purely from management fees for a full decade, entirely independent of whether the fund's portfolio companies ultimately thrive or collapse. The upside from carry is real and can be enormous on a successful fund. But the downside for the VC partner personally is remarkably soft, since the management fee alone can fund a genuinely comfortable career, even through a fund that performs mediocrely by industry standards. Scale this across a firm managing several funds simultaneously. An early fund still collecting fees, while a newer fund is actively deploying capital, and a large firm can generate tens of millions of dollars in guaranteed annual fee income across its total assets under management, completely separate from whether any individual startup in any individual fund ever becomes profitable. Compare that to the founder's position, where a salary is often modest by design, sometimes explicitly capped by the VC's own term sheet, and nearly all of their financial upside is tied entirely to an exit that may never happen. The fund manager gets paid on a predictable schedule for a decade. The founder gets paid, if at all, only once, and only if the dice land exactly right. This is the concept that explains almost every strange, aggressive decision venture capitalists make, and it's called the power law. In a typical venture portfolio, the overwhelming majority of investments will fail outright or return roughly the money invested, while a tiny handful of massive winners generate essentially all of the fund's actual profit. That reality creates a brutal, counterintuitive incentive. A VC doesn't actually want a startup to become a safe, steadily profitable $10 million a year business, even though that would represent genuine, real-world success for the founder and every employee involved. If a startup doesn't have credible potential to return the entire fund on its own, a billion-dollar plus exit, it is, in the cold math of the power law, essentially useless to the VC's overall portfolio strategy. This is precisely why VCs consistently push founders toward aggressive, winner-take-all growth strategies, expand into new markets before the current one is fully proven, hire faster than revenue can support, chase total market domination instead of sustainable profitability, because a merely good outcome does almost nothing for the fund's overall returns. A founder who wants to build a stable, modestly profitable company is often actively at odds with their own investors' financial incentives, and that misalignment regularly pushes otherwise healthy companies to take on existential risk, chasing a scale they may never actually reach, sometimes driving a perfectly viable business straight into bankruptcy in pursuit of a unicorn outcome the math demanded all along. Think about what this actually means in a board meeting. A founder walks in with a company growing steadily, profitable, healthy, sustainable. Under normal business logic, that's a success story worth celebrating. Under power law logic, if that company's total addressable market caps out anywhere below the size needed to return the whole fund, the VC board members may quietly view it as a disappointment relative to the fund's actual math, even while publicly praising the team's execution. That disconnect between what looks like success to a founder and what counts as success to a fund is one of the most misunderstood dynamics in the entire startup ecosystem. And it explains why so many venture-backed companies chase growth well past the point where it makes rational, standalone business sense. It's also why the same VC who told a founder to go big or go home in the pitch meeting can, years later, be the one voting to shut the whole thing down the moment it becomes clear the fund returning outcome simply isn't going to happen. Act 4. Board control. Who actually runs the company? There's one more mechanism worth understanding before we get to the exit itself, because it explains why founders so often lose control of the very company they started. In exchange for their investment, VCs typically negotiate one or more seats on the startup's board of directors, along with protective provisions that require board approval for major decisions, raising future funding, selling the company, or even replacing the CEO. In the early days, this feels like a partnership, experienced investors offering guidance to a first-time founder navigating unfamiliar terrain. But as more funding rounds close, the board composition shifts, and it's common for VCs to eventually hold a majority of board seats, or enough combined influence to outvote the founder entirely on critical decisions. This is exactly how some of the most famous startup founders in history have been removed from their own companies, by the very board members their investment brought on. From the VC's perspective, this isn't betrayal. It's simply the protective mechanism working exactly as designed. A way to replace a founder who isn't executing toward the billion-dollar outcome the fund's math requires with someone who might. From the founder's perspective, it can feel like building a house for a decade only to be handed the keys back and shown the door the moment the numbers stop looking like a power law winner. Before we even get to what happens at the exit, there's another mechanism quietly working against founders throughout the life of the company: the follow-on funding trap. Once a startup takes venture money, it's rarely a one-time transaction. Growing fast enough to satisfy the power law requires burning cash aggressively, well beyond what current revenue supports, which means the company will almost certainly need to raise another round, and then another, every 12 to 18 months, each time selling off another slice of ownership. If the company is performing well, this is manageable. Each new round comes at a higher valuation, and dilution is offset by growth in the overall pie. But if growth stalls even slightly, the company may be forced into what's called a down round, raising new money at a lower valuation than the previous round, which disproportionately dilutes founders and early employees, while existing investors are often protected through anti-dilution provisions written into earlier deal terms. Some VCs will even structure a follow-on investment specifically to take advantage of a founder's desperate need for cash, offering harsh terms because they know the alternative is running out of money entirely. This is why founders sometimes describe fundraising as a treadmill they can't step off of. Every round buys 18 more months of runway, but also locks in another round of investor favorable terms that chip away further at what founders and employees will actually walk away with if the company eventually sells. Here's the ultimate insider secret that explains what actually happens on the way out, and it's the part of this system that most founders don't fully understand until it's far too late. When a startup finally gets sold or goes public, the proceeds don't simply get divided proportionally based on who owns what percentage of the company. Venture capital investments almost always come with what's called a liquidation preference, a contractual right that guarantees the VC gets their invested capital back first, before founders or employees see a single dollar from common stock. In a strong outcome, where the company sells for far more than was ever invested, this preference barely matters, since there's more than enough value to go around for everyone. But if a company sells for anything less than the rosy valuation everyone was originally hoping for, the liquidation preference becomes a trapdoor. VCs can trigger their preference and walk away with 100% of the sale proceeds, sometimes even more than their original investment through a multiplier written into the deal terms, leaving founders and early employees with functionally $0 after years, sometimes an entire decade, of unpaid or underpaid work building the company from nothing. This is the mechanism that quietly protects venture capital's downside even in a mediocre or disappointing exit, while founders and employees, who typically hold common stock with no such protection, absorb nearly all of the actual risk in exactly the scenarios where things didn't go according to the original plan. Stack multiple rounds of financing on top of each other, each with its own layered liquidation preference, and the math gets even more punishing, since later investors often negotiate the right to be paid out before earlier investors too, creating a strict waterfall where common stockholders, the founders, and every early employee who joined for the equity sit at the very bottom of the payout order, first in the door and last to get paid. Given all of this, it's worth asking why founders keep signing these deals at all, and the honest answer is that venture capital genuinely does solve a real problem for a certain type of company. Building something like a new social platform, a biotech breakthrough, or an entirely new category of software often requires years of capital-intensive work with no revenue in sight. Capital that traditional bank loans or bootstrapped savings simply can't provide at the scale or speed required to compete. For the rare founder building something with genuine billion-dollar potential, venture money is often the only realistic path to actually reaching that scale before a better-funded competitor gets there first. Beyond the capital itself, a strong venture firm can also open doors that would take a founder years to open alone. Introductions to enterprise customers, access to top engineering talent, credibility with the press and future investors, and hard-won pattern recognition from having watched dozens of similar companies scale before. The problem isn't that venture capital exists, it's that the same aggressive, power law-driven playbook designed for genuine moonshot companies gets applied uniformly to every startup that walks through the door, even the ones that would have been perfectly successful, sustainable businesses if they'd simply been allowed to grow at a normal, profitable pace instead of being pushed toward an all-or-nothing outcome the math demanded from day one. A founder building a genuinely good, durable business sometimes has to actively resist their own investors' advice to keep that business intact, which is a strange position to be in when those same investors are sitting on the board with real voting power over the company's future. So is venture capital rigged? In a very specific structural sense, yes, and understanding that structure is the entire point of this video. The fee model guarantees VC partners get paid regardless of portfolio performance. The power law mathematically requires the overwhelming majority of funded companies to fail or underperform, by design, not by accident. The follow-on funding treadmill quietly dilutes founders round after round in the name of chasing that same brutal math. And liquidation preferences ensure that even when a company does eventually sell, the investors get protected first, while founders and employees absorb almost all of the downside risk in anything short of a spectacular outcome. None of this makes venture capital evil exactly. It makes it a highly engineered financial instrument built primarily to serve the LPs writing the checks, with founders and their companies functioning as the raw material that machine runs on. Understanding these mechanics doesn't mean avoiding venture capital entirely. It means walking into that conference room knowing exactly whose interests the term sheet on the table was actually designed to protect first and negotiating accordingly instead of simply being grateful for the check. That's the real economics behind venture capital, a fee structure that pays partners regardless of outcome, a power law that mathematically requires most startups to fail, board seats that can quietly cost a founder control of their own company, and Liquidation preferences that protect investors first when an exit falls short of the dream. The founders take the risk, the employees take the risk. The house, as it turns out, almost always gets paid. If videos like this help you see industries differently, subscribe. There's a lot more where this came from. See you in the next one.